On July 15, 2026, the Bank of Canada did exactly what many of us do when someone asks where we'd like to eat for dinner. It decided to do nothing. In fact, the bank has now held its rate steady for 6 consecutive announcements. At this point, the overnight rate is becoming like that one friend who says they're just about to leave, but is still standing in the doorway 45 minutes later. Now, I know the words overnight rate have a magical ability to make people's eyes glaze over faster than 2-hour tax seminar. So instead of speaking like a fluent economist, let's translate what July 15's announcement actually means for your mortgage, your upcoming renewal, and whether a fixed or variable rate mortgage makes the most sense right now. Here's a short version. The economy is actually looking a little bit better than it has in a while. The growth is starting to pick back up, and the bank expects inflation to gradually ease off after a recent spike. But there are two big wild cards hanging over everything: the war in the Middle East and the ongoing uncertainty around US trade policy. Until those settle down, the bank isn't in a rush to move in either direction. A big part of the story right now is oil. The conflict in the Middle East has pushed oil prices higher, and that's rippling through the global economy. It's actually helped some countries. The US is growing around 2.5%, driven by strong consumer spending and a massive wave of AI related investment. And China's economy is holding up well thanks to strong exports. Europe hasn't been as lucky, with high energy prices weighing things down, though the bank expects things to improve there if energy prices cool off like they're projecting. This is the part that matters most for your rate outlook. Inflation actually rose to 3.2% in May. And gas prices tied to the Middle East conflict are the main reason why. Strip out gasoline, and inflation is sitting at 2.2%. With core inflation hovering close to the 2% target, the bank expects headline inflation to stay elevated for a bit longer before gradually cooling back down to around 2% in early 2027. But they're upfront that this whole forecast depends heavily on where oil prices go from here. Canada's economy has had a rough, choppy stretch over the past year. Tariffs, uncertainty, and slower population growth all took a bite out of growth, and the unemployment rate has been sitting in that 6.5% to 7% range since the end of 2024. But there's a real bright spot here. Growth resumed in the second quarter, coming in around 2.5%. Consumer spending has stayed solid. Housing activity looks like it's stabilizing after being weak, and exports are picking back up. Business investment is expected to improve too, with an early boost coming from the oil and gas sector. Looking further out, the bank expects the Canadian economy to grow 1.8% in both 2027 and 2028, following relatively modest growth this year. As that recovery plays out, the extra slack in the economy should slowly get absorbed. Bottom line from Governing Council, they believe the current rate is still the right setting to support the recovery and get inflation back to target. But they're keeping the door open to adjust if things change. The next scheduled rate announcement is September 2nd, with the next full monetary policy report landing October 28th. What this means if you're in a variable rate mortgage. If you're in a variable rate mortgage right now, nothing changes for you. This cycle, your payment stays exactly where it is. The bigger question is timing. With inflation still a bit sticky because of oil prices, I wouldn't expect an aggressive string of cuts in the near term. This is more of a wait and see hold, which means variable rate holders should stay patient rather than assume relief is right around the corner. If you're coming up for renewal, this hold gives you a bit of breathing room to plan rather than panic. Fixed rates are influenced more by bond yields than the overnight rate directly, and those have stayed relatively steady in Canada. Even as US yields have climbed, that's actually part of why the Canadian dollar has softened a bit. If you're renewing in the next few months, now is a good time to start comparing options rather than waiting until the last minute. What this means if you're house hunting. Housing activity has been on the weaker side, but looks to be leveling out. If you've been sitting on the sidelines waiting for a big rate cut before you jump into the market, July 15's announcement suggests that relief may take a little longer to show up than some people expected. That doesn't mean don't buy. It means go in with realistic expectations about where rates are likely to sit over the next few months rather than banking on a big drop. Here's the bottom line. Nothing dramatic happened this time around. The Bank of Canada is holding steady while it watches the conflict in the Middle East, global oil prices, and ongoing trade uncertainty with the United States, all while keeping a close eye on inflation. As I like to say, when the US catches a cold, Canada catches the sniffles. We're so closely connected economically that what happens in the south of the border almost always has an effect here. Maybe we don't end up with a full blown cold, but we usually end up reaching for the tissues. For now, the bank is choosing patience over panic, and that's exactly what many homeowners should be doing too. Whether you're buying, renewing, refinancing, or deciding between a fixed and variable rate, don't make decisions based on headlines alone. Build a strategy based on your own financial goals, and if you're not sure what the strategy should be, that's exactly what we tried to help you with. This is Rasha Ingrata, Mortgage Agent Level 2 with Mortgage Intelligence in Windsor, Ontario since 1999. Have a wonderful day.